1. Start with energy, explain with authority, highlight with emphasis, end with warmth. Good morning. As we approach the U.S. market open, the board is still in pre-session. Beyond Meat, ticker BYND, closed yesterday's trading on November 11th at $1.22 per share. As of this moment, 9:11 a.m. Eastern Time, the pre-market quote is $1.23, a tiny move up of about 0.80%. Now, the immediate expectation for 99% of people, especially those who remember this stock's glory days, is to just laugh and scroll past. This is a name that has fallen from an all-time high of over $230 a share to trade where it is today. The common belief is that this is a dead company, a failed fad, a penny stock just bleeding out to its inevitable conclusion of zero. The story's over. The revolution failed. But the reality of what is happening with this company is far more urgent and far more dramatic than a simple 0.8% pre-market twitch. That $1.23 price isn't just a number. It is the market's brutal, unfiltered verdict on the catastrophic third quarter 2025 earnings report that the company just dropped 2 days ago, on Monday, November 10th. When that report hit the wires after the bell, the stock plunged 9% in after-hours trading. This morning's stability isn't a sign of recovery. It's the stock trying to find a bottom after the market has fully digested the news that this company is in a five-alarmed fire, fighting for its literal survival. Let's be perfectly clear about what those Q3 numbers showed, because the expectation of a tough quarter was completely shattered by the reality of an operational collapse. This is the kind of data that investors using Fidelity Investments or Interactive Brokers need to see, not just the headline. Net revenues didn't just miss, they fell off a cliff. Revenue was $70.2 million, a stunning 13.3% decrease from the same period last year. But even that number hides the real sickness. The core of their business, U.S. retail, the grocery store sales that were supposed to conquer the world, collapsed by 18.4%. Their U.S. food service business was even worse, down 27.3%. This isn't a slowdown, this is a full-scale consumer rejection of the product in its primary market. The volume of product sold, the actual amount of meat people are buying, dropped by over 10%. Consumers are not making repeat purchases. The fad is, by the numbers, over. This isn't a growth story anymore. It's not a hot tech stock like Nvidia stock or even a volatile consumer brand like Tesla stock. This is a distressed asset, plain and simple. But the revenue decline wasn't even the most terrifying part of the report. The real bombshell was buried in the income statement. The company reported a net loss of $110.7 million for the quarter. Let that sink in. They generated $70 million and managed to lose $110 million. How is that possible? It's possible because the loss included a $77.4 million non-cash impairment charge. This is critical. This is accounting speak for we are officially admitting that our factories, our equipment, and our assets are not worth what we said they were. This is management formally acknowledging that the revolutionary manufacturing infrastructure they built, the basis for their entire valuation, is now worth significantly less because the demand they expected simply never showed up. This is the reality puncturing the expectation in the most brutal financial way possible. It's an admission of a massive strategic failure. This brings us to the most important number for any investment in this company right now: cash. As of September 27th, Beyond Meat had $131.1 million in cash. In the last quarter alone, their free cash flow was negative $41.69 million. They are burning cash at a terrifying rate. This isn't a long-term problem. This is a short-term survival crisis. At this burn rate, the company has roughly 3, maybe 4 quarters of cash left before the lights go out. This is the ticking clock that the market is listening to. That $1.23 price is the market pricing in a very, very high probability of bankruptcy or a deeply dilutive emergency capital raise in the next 12 months. This is why the stock isn't something you'd find in a diversified Fidelity ETFs or Fidelity mutual funds portfolio, and it's certainly not a candidate for a set-it-and-forget-it Schwab Intelligent Portfolios account. This is a pure high-stakes gamble that you'd only touch in an individual brokerage account if you are an expert in distressed assets and special situations. Now, management is not stupid. They see this. CEO Ethan Brown's comments on the earnings call were not those of a growth story CEO. They were the comments of a general in full retreat trying to establish a defensible perimeter. He's trying to pivot the narrative. The expectation he's trying to sell is a fundamental reset. He's talking about a transformation and a new balance sheet. He's right about one of those things. The company just completed a complex debt for equity exchange. In simple terms, he convinced his bondholders to swap their debt, which was unlikely to be repaid, for stock, significantly reducing their total debt by about $900 million and extending the maturity dates. This was a brilliant financial move. It cleans up the balance sheet and buys them time. But here is the central brutal tension of this stock. Can financial engineering save a company whose core product is failing in the marketplace? It doesn't matter how clean your balance sheet is if you're burning $40 million in cash every 3 months because not enough people want to buy your burgers. This is the ultimate disconnect. The old expectation for Beyond Meat was built on a simple, world-changing idea. Use pea protein and other plant-based ingredients to perfectly replicate the taste and texture of meat, disrupt the multi-trillion-dollar global meat industry, and help save the planet. This story was so powerful, it led to one of the most successful IPOs of all time, and partnerships with giants like McDonald's, Yum Brands, KFC and Taco Bell, and Panda Express. But the reality is that those partnerships have largely fizzled. The McPlant, after a promising test, did not get a national rollout. The Panda Express Beyond the Original Orange Chicken was a limited-time offer that came and went, not a permanent menu staple. The U.S. consumer in an inflationary environment looked at the high price, the long list of processed ingredients, and the taste and simply said, no thanks. They went back to cheaper, less processed, traditional meat. This is why U.S. retail sales are in a free fall. The new pivot is one of desperation, and you can hear it in the CEO's language. On the earnings call, Ethan Brown said they would be placing increasing emphasis on the word beyond versus beyond meat as we go forward. This is a massive tell. This is a signal that he may be realizing the Beyond Meat brand itself is too damaged or the category too toxic. He's trying to broaden the aperture to a global protein company. This could mean anything: ingredients, new categories, private label, but it's a clear admission that the original high-margin branded burger plan has failed. He is now in full-on survival mode. The entire plan is to cut, and cut some more. Layoffs, slashing the product portfolio, and pulling back from operations in China are all part of this brutal effort to shrink the company down to a size where it can maybe become cash flow break-even on a tiny $60 million revenue base. This is an incredibly difficult task. The other, more likely bull case for this stock is not a growth case, it's a survival case. The bet is that Ethan Brown's cost-cutting will be so deep and so fast that he can get the company to cash flow break even on a tiny $60 million revenue base. This is an incredibly difficult task. The other more likely bull case is that a major food conglomerate, like a Tyson or a Nestle, comes in and buys the company for its brand and manufacturing assets for pennies on the dollar, perhaps at $2 or $3 a share, just to put it out of its misery. This is what makes this stock so different from almost any other name on the market. It's not a SoFi Invest app or Robinhood app play where you're betting on a new product launch. It's not Apple stock where you're analyzing iPhone cycles. This is a death match against the balance sheet. Given this cash burn rate of over $40 million in quarter and a $131 million cash pile, how many quarters do you think Beyond Meat has left before it's game over? Let me know your honest prediction in the comments. Looking forward, the outlook is